Hello, and welcome back to week 22 of the No BS Homebuyers Live series. Today, we are going to be breaking down the home buying process into simple and easy to understand steps so that way you can go from thinking about owning to actually owning a home. So, today, we're just going to imagine finding our dream home and getting your offer accepted, and then discovering that the foundation is cracked or the appraisal comes in low and the financing falls apart. Would you still want to be forced to buy this house? Absolutely not. So that is what contingencies are for. And we're going to talk about what the word contingency actually means and what kind of safety net it provides for buyers. So that way you're understanding what's going on in your buying transaction. So let's just remember that contingencies aren't loopholes, they are protections for you as buyers. So let's just jump in and start with what is a contingency? A contingency is simply a condition that has to be met in order for the contract to move forward. These are pre-built into contracts so that way you are covered in some pretty popular contingencies, those being inspections, appraisals, and just financing in general. But you can kind of think of a contingency like a checkpoint in the process of buying. So if something major happens at one of these checkpoints, you have an option to either renegotiate or walk away. Contingencies, that's what they're built in for. So a contingency says, I will buy the house so long as everything checks out. And then you can continue to move forward. So let's talk about probably the most commonly known contingency, and that is the inspection contingency. This is usually the one that buyers are most familiar with or that they understand the most. It can also be known as an inspection period. So the inspection period gives you the opportunity to learn more about the condition of the home. And if it doesn't qualify in your mind, then you have the inspection contingency to back out. So a lot of common ones that we see are more of the big financial issues. So if there's roof issues, if there's foundation concerns, electrical problems, plumbing issues, or just in general safety issues that come up on an inspection, then you have that inspection contingency and that inspection time frame to decide whether you want to continue to move forward. During that time frame, you can also ask the sellers to do repairs or for some sort of credit. But that is, in a nutshell, what the inspection contingency is. And one week we will go deep into inspections and talk a lot more about that specific topic. So I won't beat a dead horse today. But one thing to note with the inspections is you're never going to find a perfect house. Every house is going to have some issues, but that is what that contingency is built for. So you have the chance to address it. And when you put in that offer, you're not locked in if you find something terribly wrong, unless, of course, you write off the inspection contingency. But we also just want to remember that every house has flaws. The goal is to understand them before you buy and understand the contract and how you could potentially get out of a contract with an inspection contingency. All right, now let's talk about the next most common contingency, which is the appraisal contingency. And I am realizing that this is quite the tongue twister. So if I start saying it wrong, I apologize. But an appraisal answers a very important question. And typically the bank is the one who is ordering the appraisal. And that is the home worth what you're paying for it? And the appraisal contingency and the financing contingency a lot of times go a little bit hand in hand. Essentially, if your house, let's say you put an offer in at $300,000, but the appraisal comes in and says $290,000, well, the lender is only going to lend based off of what the appraisal comes in at. So oftentimes in a contract, you will see that the property has to appraise at or above the purchase price, or it becomes a renegotiation period, or the buyer has the opportunity to walk away with their earnest money. So in situations where you have a low appraisal, there are different outcomes that can happen or different approaches that you can take depending on your financing. So a lot of times if you can't bring additional cash to the table, that is one way to cure it, is by you, the buyer, bringing additional cash. But if you can't, the sellers need to be lowering the price. Or you might find a little meet in the middle area where you bring some cash and they lower the price some. But it all will depend on what your financing allows you to do. And if you can't come up with an agreement, then the contract terminates, and then you as the buyer would get your earnest money back. Again, please make sure you're running all of this by your realtor and making sure that you're understanding the contract you're signing. But these are pretty common contingencies all throughout the United States. But we have to remember the appraisal contingency is oftentimes to protect the lender, or it's also to protect you as the buyer. But the lender is who cares about the value, and they're going to be the ones that are funding the property. And if the property isn't appraising, they're not going to lend you that money. That's essentially the appraisal is saying, hey, the house isn't worth what you're offering. So the banks don't want to be underwater before they even put a loan out. So that's why appraisal contingencies matter. And then, like I said, the financing contingency kind of goes hand in hand with this one. If you can't get the property appraised and you can't bring extra cash to the table and the sellers aren't willing to come down, then you have an out there. But the financing contingency also encompasses if your financing doesn't come together despite your best efforts. So this could be unexpected things like employment changes. If you lose your job and then find another job that's not in the same career field, the underwriters might have a hard time justifying that, thus not allowing you to get financing. And then qualification changes, say, there are situations where you have a certain income level and you're qualified for a certain loan, and then on a good note, you get a raise, but now you are kicked out of that financing. So that could be an issue, but it can also happen where, you lose your job and get a job in the same field, but maybe not for as much money. Well, your financing might not work at that point. So that is another situation with financing. Or if your loan gets denied, or unexpected underwriting issues, most of the time you're going to be able to know when you're getting your pre-approval that you will get the loan, because they should be looking at all of your paperwork ahead of time. But there are certain cases that things come up and they're like, well, this wasn't disclosed to us, or we didn't know about this until just now, and we actually can't lend to you on that. And that could be qualifying income, like where your income is coming from. That could be you pulled out a new line of credit to buy a washer and dryer before you closed, which you're not allowed to do. That's my personal recommendation, is do not do that. Don't open new lines of credit, because that can really affect your financing, and then that can cause you to not get financing. But that financing contingency is in there so you aren't hopefully losing your earnest deposit because you can't get financing. Now, we do understand that the pre-approval is really great and really should hammer through a lot of these issues, but nothing is final until the closing docs are signed. So we want to make sure that whatever we're doing in our escrow period or while we're under contract aligns with the financing that we need. And we want to be talking with our lender to make sure that we are still in the clear and good to go by the time we close. But pre-approval does not mean you're guaranteed, which is why we have the appraisal contingency and why we have the financing contingencies built into purchase agreements. So why contingencies really matter. In competitive markets, you're going to hear about people waiving contingencies. And probably the most common one is the inspection contingency, just writing off inspections. Whether you are writing them off completely or writing them off for info only, if you are signing away that you will not be asking anything for an inspection, you are writing off that contingency. So that you don't have that to protect you. If something comes up, you can't use that as a way to get out of the contract. And before you're even considering writing off a contingency, you need to understand what protections you're giving up. If you're writing off the inspection, you don't get inspections, or if you do get inspections, you don't get to ask for anything or ask the sellers to fix anything. You are accepting that property as is. If you write off the financing contingency and you are still planning on getting a bank loan, but then for some reason the bank loan falls through, the sellers can sue you to close on that property. So just be very aware of what you're writing off if you are planning to write off contingencies. And for my first-time home buyers, please don't write off any of the contingencies. They're very important to the contract and very important to a successful, positive outcome for you. But every situation is different, and you just need to understand the risk and understand what's critical for you in order to close. And contingencies exist because buying a home is a really big decision. Obviously, it is probably the biggest decision in a lot of households or a lot of people's lives, and the biggest money decision in a lot of people's lives. So we don't take these things lightly, and that is why these contingencies are built into the loan process or the purchasing process. So that way it can protect you, a buyer who is potentially doing this for the first time or many times. But these contingencies protect first-time homeowners and multiple homeowners. They are in the contract because historically, I'm sure there was a problem where, you didn't get a home inspection and now you're forced to buy this house. There's a reason they're in here and there's a reason they're common. So just understanding what they are for and the timelines that go with them. Like typically an inspection will begin at the beginning of a contract once you go under contract. And where I'm at, it's 14 days. I know 10 days is pretty common, and you got to make sure you know if that's business days or calendar days, because those are different things. And you just really need to understand what that means at the beginning of the contract, so that way you are following the timelines and deadlines properly, because that is also part of the contingency wording. And then with the financing one, there may be a drop dead date. Like if you aren't applying for a loan within a certain amount of days, you could be out of the contract, or I can't think of the exact word right now, but you could be violating the contract, and then that can get the sellers and out. So you just have to really make sure that you're paying attention to what the contingency is, what the requirements of the contingency are to keep them in place, and then abide by those rules, because they are designed to help you as a buyer gather information, verify facts, and make informed choices in your purchasing decision. So you just really want to be paying attention to what they are and what they mean and the timelines associated with them. But confidence in this comes from, one, having a good realtor that will help you through that and guide you and keep you on track. But it also comes from understanding your options and understanding what these things mean. And so you're doing the right steps to get informed and learn. So congratulations, that's exciting and awesome. But if you continue to need help, or if you're making offers and you want some help understanding what all of the documentation means, please have a trusted advisor on your side. And that trusted advisor is going to be your realtor. They do this every single day, and they should understand the contract that you're signing and be able to explain it in layman's terms. So that way, you are doing what is in your best interest. And then they should also be able to help you with the timelines and keeping on top of things. But you as a buyer also need to be informed. It is so important. This is a lot of money. So don't take it lightly. Read your contract, make sure you understand what you're signing, and understand if there is a problem, what you have to do in order to either fix that problem or get out of the contract. Well, if there are no questions today, I will go ahead and send you off with a thank you for tuning in on contingencies. Thank you for learning about them, the inspection, the appraisal, and the financing contingency. Those are the top three most common. Every contract should have a place where you can write in different things. Probably another potential one would be like insurance. It must be fully insurable. We're seeing that a lot with roofs. If you can't get insurance on the roof, then, we're not going to close on this property and we want our money back. So you can write in whatever kind of contingencies you want, but I would say we've hit the most three common. And if there are any questions, let me know. Otherwise, we are going to be diving into another step next week, and let me remember what it is. I think we're going to be talking about negotiation strategies, and different things like that for writing an offer. So If you want to continue to help move forward with more clarity and confidence and understanding in the home buying process, please join us again next week. And don't forget, this is the No BS Home Buyers Live series, where we're breaking down the home buying process into simple, no BS steps to get you thinking about buying and get you to actually owning. So thank you so much for joining me today, and I will see you next week.